Hi everyone, I'm Sarah Stokes with Coast to Coast Mortgage Lending, and welcome to your Friday mortgage market closing bell for the week ending July 17th, 2026. Let's take a look at what happened this week, why mortgage rates moved, and what to watch for next week. The good news is that mortgage rates actually finished the week a little better than they were at the start after some encouraging inflation data came out earlier in the week. Mortgage News Daily's 30-year fixed rate closed today at approximately 6.63%, which is slightly better than yesterday's close. While that's still quite elevated compared to earlier this year, it's an improvement from the highs we saw at the beginning of the week. So what moved the market exactly? The biggest story was inflation. Tuesday's Consumer Price Index, or the CPI, and Wednesday's Producer Price Index, or the PPI, both came in cooler than many economists expected, and that's important because lower inflation generally does help the bond market, and when the bonds improve, mortgage rates improve as well. Those reports gave investors confidence that inflation might actually be moving in the right direction again, which helped Treasury yields and mortgage-backed securities. It helped them to recover during the middle of the week. So now, if that sounds like great news, there's still one more wild card, and that is oil. Markets continue to keep a very close eye on the conflict involving Iran and the Strait of Hormuz. Any disruption to oil supplies can push gasoline higher and diesel higher, and then higher energy prices can eventually work their way into inflation. And that's something bond investors and mortgage rates really don't like. So even though inflation reports were encouraging this week, geopolitical tensions continue to keep markets on edge. So what should we watch for next week? Well, there are several reports that could move mortgage rates. We'll get MBA mortgage applications, initial jobless claims, S&P Global Manufacturing and Services, PMI, new home sales, building permits. All of these reports help investors gauge the strength of the economy and the housing market. Then we've got the Federal Reserve. It's entering into its blackout period ahead of the July 29th FOMC meeting, so we won't hear much from the Fed officials at this point. Right now, markets appear to believe that the Fed is more likely to hold rates steady later this month when they meet after the week's softer inflation reports, which is good. But that outlook could change if economic data surprises to the upside. So what's my outlook? I expect mortgage rates to remain volatile. Who knows? They could go up and down. The encouraging inflation data is definitely a positive sign, but the market is still balancing that against higher oil prices, geopolitical uncertainty, and a resilient labor market. If inflation continues to cool over the next few weeks, there's room for mortgage rates to improve. But if energy prices spike again or economic data comes in stronger than expected, we could see rates move even higher. The bottom line is this: trying to perfectly time the market is nearly impossible. So if you're thinking about buying a home this year, the most important thing you have is a strategy. Remember, you can always refinance later when rates come down, but it's much harder to go back and buy that house that you may have lost while you were waiting for the perfect house. If you like a personalized payment scenario or you want to know how today's rates affect your buying power, I'd be happy to help you. I'm Sarah Stokes with Coast to Coast Mortgage Lending, and thank you for watching this week's Mortgage Market Closing Bell, and I'll see you next Friday.